depending on where you are. My name is Alexandra Reedhead, and I'm IGF's Technical Advisor on tax and extractive industries. We'd like to welcome you to the IGF webinar on the cost of tax competition in mining. We're delighted that so many of you could join us today. So today we'd like to share with you some of the work that IGF has been doing together with the OECD on tax incentives in the mining sector. The agenda for today's webinar is as follows. I'm going to briefly introduce the topic and then hand over to my colleague, Jacqueline Terrell, who will share some insights on the prevalence of tax incentives in the mining sector. Jacqueline will be drawing on our brand new database covering mining tax incentives in 21 countries, and we're delighted that you're the first people to see this database. I will then briefly talk about some of the risks to government revenue arising from tax incentives. After that, I will hand over to my colleague Ian Steele, who will take us through the IGF tax incentives financial model, which can be used to estimate the cost of tax incentives. Then we will invite our discussants, Vincent Keddy from Uganda and Ousmane Cissé from Senegal, to share their country's experiences with mining tax incentives. You'll see on your screen in front of you that there's a chat function. Please send us questions using the chat function throughout the webinar. We will then capture your questions and respond to them during the last 30 minutes of the session today. So to briefly introduce our topic today, the analysis of tax incentives faces fundamental definitional challenges related to the determination of the relevant benchmark. The benchmark, and hence what constitutes a tax incentive, will differ from country to country. In our work, both in the practice note that we've already issued with the OECD, and indeed in the financial model and the database that we're going to share with you today, we define a tax incentive to be any special tax provision granted to mining investors that provide a favourable deviation from the general tax treatment that applies to all corporate entities. So, for example, if the benchmark was that all corporate entities must pay income tax at a rate of 30%, the incentive would be that mining investors pay income tax at a rate of 25%. Moving on to the next slide, you can see here in front of you a table containing a number of typical mining tax incentives. So as we know, mining tax incentives can take many different forms. The list in this table is not exhaustive, but includes some of the more typical incentives, and indeed the incentives that we capture in our practice note, in our model, and in our database. So you can see, for example, in relation to taxes on income, you might have an income tax holiday. That might be a partial income tax holiday or a complete tax holiday where no income tax is due during that period. You might have incentive related to taxes on production, so seeing a reduced royalty rate or a sliding scale royalty rate if indeed the benchmark provides for a flat royalty rate. So these are some of the types of tax incentives that we see in the mining sector. As I said, it's not exhaustive, and you can look at our practice note for more information on these as well. Again, just reiterating the fact that incentives are going to vary from country to country depending on what the benchmark fiscal regime is. And lastly from me, a webinar on tax incentives would not be complete without briefly considering the effectiveness of tax incentives, although we're not going to go into a lot of detail on that today. In this regard, there is limited evidence that tax incentives are effective at attracting investment in developing countries in general. You can see on the screen there, we refer you to a number of studies that have been undertaken in recent years that support this finding. Looking at the mining sector specifically, whilst there are no empirical studies on the effectiveness of tax incentives at attracting mining investment specifically, we think it's reasonable to assume that given that the resource cannot be moved, that tax incentives are going to be a less significant driver of investment decisions in the mining sector. So I'm going to pause there now and invite my colleague Jacqueline to share with us some insights from our new IGF Mining Tax Incentives database. Jacqueline.
Thank you, Alexandra. Hello, everyone. My name is Jacqueline Terrell, and I will introduce for the first time the tax incentives dataset, which intends to be a collection of files comparing the fiscal regimes of 104 mining projects across 21 resource-rich countries. This dataset is the first large-scale attempt to compile tax incentives used by developing countries, and has as its main objective to identify the prevalence and type of tax incentives used in the mining sector. Of course, this has been made possible thanks to the greater contract transparency, and in particular, the public availability of contracts compiled by the Natural Resource Governance Institute, NRGI. Now, this map will give you an idea on what we have covered. As you can see, we have reviewed 104 contracts around the world, 82 in Africa, 11 in Asia, and 11 in Latin America. An important question is, how did we select the mining tax incentives? Whether a fiscal term is a tax incentive depends on the country's legal framework, in particular, the law that applies to all taxpayers by default, what we call the benchmark fiscal regime. If the term in question provides a favorable deviation from the benchmark fiscal regime for mining investors, it will be deemed as an incentive. So to identify tax incentives, first we studied the General Tax Code. Here, all terms more favorable to mining in relation to other economic sectors were marked as an incentive. Second, we reviewed the Mining Code. Here, all terms more favorable than incentives in the tax code were identified as incentives. And finally, we reviewed the mining contracts, where all terms more favorable than incentives in either the tax or mining codes were marked as incentives. Now, 2 points. In some countries, mostly in Anglophone Africa, the mining tax law is included as part of the General Tax Code rather than in a mining code. In these cases, the mining tax law is treated as part of the General Tax Code. Second, if the country had the same incentive in the law and in the contract, but the incentive in the contract was more favorable, both are counted in the database. For example, let's say the corporate income tax rate in the law is 25%, and the contract grants a corporate income tax rate of 10% to a specific project. Then both are counted as incentives. Now, to give you an idea on what you will find in the mining tax incentives dataset, I will share with you my screen. And here is the mining tax incentives database. You will find here 4 sheets. First, the cover sheet, then the quantitative data, then the summarized data sheet, and the raw data sheet. The cover sheet includes an introduction, our data sources, the files that we analyze, then an explanation on how to read the quantitative data and the summarized data as well. Also, a color code for reading the summarized data tab, and the definition of incentives in both the law and the contract. Then you will have the quantitative data sheet, which summarizes our conclusions as to whether each contract and law has an incentive in each category. Then the summarized data sheet includes all details on the nature of incentives identified in a summarized version, in comparison with the raw data sheet that includes what is actually in the original provisions in laws and contracts. So now that we know how the data set looks like very briefly, we will get back to the slides and share some interesting findings that we have identified. So I will stop sharing. Sorry. Okay, so as we can see in this graph, which shows the number of tax incentives by region, we found that it is more common for countries to grant incentives in the primary law than in contracts. Of course, without considering the type of incentives, it's positive that a greater proportion are granted in the primary law, which is public and subject to legislative review, rather than by contract, which are often discretionary, secret, and vulnerable to corruption. However, Africa grants considerably more contract-based incentives, raising concerns about the level of transparency and accountability for decisions to grant incentives, and of course, the potential for corruption. Then, as you can see in this graph, which shows the prevalence of each tax incentive included in the data set, a second finding is that the two most common incentives in both the primary law and mining contracts are the use of tax stabilization provisions and corporate income tax incentives. We invite you to review in the cover sheet of the data set the definitions of these tax incentives both in the law and in the contracts. Then we also found that withholding tax incentives are very common. Interesting to see also that reduced withholding tax rates are the rule, while withholding tax exemptions are less common. Another interesting finding on withholding taxes is that some contracts point out that companies will pay withholding taxes subject to any double tax treaties provision, which means that if a more favorable reduced withholding tax rate, let's say on dividends, royalties, interest, is granted by a double tax treaty, these rates will be more prevalent than the ones agreed in the contracts. This was the case, for example, for some contracts in Sierra Leone or Zambia. Then, as we can see in this graph that shows the average number of years of stability offered in contracts per country, another finding is that on average, taxes are stabilized for 20 years. Nearly all countries included a tax stability clause, either in the primary law or the mining contract. Moreover, in Guinea, in Burkina Faso, in Burundi, in Madagascar, in Mali, we found that these countries offer 30 to 34 years of stabilization on average in its mining contracts. Another interesting finding is that corporate income tax holidays are granted for 9 years on average, as we can see in these tables. There are, of course, many reasons not to grant tax holidays, as was explained in very detail by the practice note, which I invite you to review. As a final comment from my side, keep in mind that the findings just mentioned are by no means exhaustive. We invite policymakers, researchers, international organizations, and civil society to make use of the mining tax incentives dataset, given its incredible potential. Now, I invite Alexandra to explain a bit more on the risk to revenue of tax incentives. Thanks.
Thanks very much, Jacqueline. So as you can see, the database is a very rich resource that we hope other organizations, researchers, and governments will make use of in their own work. These are just a sample of some of the findings and insights that we've gained from the database, but we expect there to be many more as well. So we will be sending you all a copy of the database as a follow-up to this webinar. So now I'm going to speak very briefly about some of the risks to revenue arising from tax incentives. So we know that tax incentives are commonly used in the mining sector, as explained by Jacqueline just now. But what is the risk with respect to government revenue collection? And these are issues that we cover in much more detail in the practice note that we published late last year with the OECD, which is called Tax Incentives in Mining, Minimizing Risks to Revenue. And the focus of that practice note is really on identifying what are the ways that tax incentives may be used that extend the tax benefit beyond that which was anticipated or intended by government. So what are the behavioural responses that investors may use in response to an incentive that increases the tax benefit available to them? So here on the screen is just a very rough ranking of the risk to revenue with respect to these incentives you see on the screen in front of you. So you can see that, for example, an income tax holiday we regard as high risk. Economic processing zones, so this is where there may be incentives granted for entities that are operating in these areas, for example, a tax holiday or lower rates of tax, and you may start to see issues of domestic transfer pricing, fiscal stabilization assurances, down to the cost-based incentives down the bottom, for example, import duty relief, other cost-based incentives. These might include accelerated depreciation, longer loss carry forwards. These types of incentives we regard as less high risk than those that are profit-based, those that rank higher in the table. And when we talk about risk and how we rank these incentives, it's really in terms of what is the risk that companies will change their behavior in response to these incentives in a way that then exceeds the tax benefit that government intended to grant. So that's what we consider to be risk and the basis upon which we rank these incentives. So just to pick up on 3 of them that came through in the findings from the database, and that is around the use of tax holidays, the granting of withholding tax exemptions, and stabilization. So the first example around tax holidays. So we know that if a government grants an investor a corporate income tax holiday, there may be an incentive for the investor to speed up the rate of production or to mine the highest value part of the deposit during the tax holiday period, such that when the tax holiday expires, there is less taxable profit for government. So you can see on the screen, this is just an example taken from our practice note, that here you've got a tax holiday that runs from 2000 to 2005. And during that period, you can see that most of the gold production takes place during that period. Also, the grams of gold per ton that are mined during that period are much higher than after 2005 when the tax holiday expires and then the mine itself closes in 2008. So this is an example of what we call high grading. So high grading might be one response by an investor to a tax holiday. How can I increase my rate of production and mine the most valuable parts of my deposit during that tax holiday so I can maximize my tax-free income, so that then after the holiday expires, there is less revenue for government to collect. Not only is government foregoing income tax during the tax holiday period, but even after the tax holiday finishes, there is less taxable profit. The example of excessive interest deductions. So Jacqueline mentioned that we also identify in the database that exemptions on withholding tax are common. So withholding tax in particular relating to interest expense. So let's consider an example where the mine receives a loan from its parent company, which might be located offshore, possibly in a low tax country. It has to pay interest on that loan. And of course, the government is able to collect withholding tax on that interest expense. Now, what you can see here is the first scenario where you've got the mine receives $600 of debt from its parent company and $400 of debt of equity, from its parent company. Now, at a rate of 10% withholding tax. So what you can see in this instance is, assuming a 10% interest rate, the company is paying $60 in interest on its debt, and then that is then subject to withholding tax at a rate of 10%, which means that government collects $6 in withholding tax. And if we deduct the $60 in interest from the gross income of $100, we're left with $40 taxable profit. Turning to the second scenario here, where we then remove withholding tax. So this relates to the incentive in the database. So here we have 0% withholding tax. So what you see here is the mine changes the way it is financed. So it increases the amount of debt it has from $600 to $800, which decreases the amount of equity it receives from $400 to $200. So in this case, if you've got, you can see here that the company increases the interest rate from 10% to 20%. And it also, as I mentioned, increases the amount of debt from $600 to $800. So here again, if you have $800 at a rate of 20%, that means it's paying $160 in interest. So if we deduct that from the gross income, $100, we have minus $60 of taxable profit, and we have 0 withholding tax. So what this example is intended to show is the way a company may respond to an exemption on withholding tax on interest expense. There's all of a sudden, there's no barrier to the company increasing the amount of debt it has, and of course, increasing its interest rate, so as to strip more of the profit out of the mine in the host country and transfer it offshore. The last example is fiscal stabilization. And I don't need to say much more here, but the fact that if we include fiscal stabilization in our contracts or in our law, then of course any tax incentives that we grant and any of the behavioral responses that are triggered as a result of these incentives, like the kinds that I've just mentioned, are going to be frozen. So we may be unable to remove these incentives, particularly where we see very high revenue leakage, possibly more than what we anticipated in granting that incentive. So those are the three areas that I wanted to touch on in terms of risk to revenue. And again, I encourage you to review our practice note on tax incentives in mining for a much more detailed discussion of these risks. But now I'm going to invite Ian to talk to us a little bit about the cost of tax incentives and how we can use the IGF financial model to estimate the cost.
Thank you, Ali, and hello, everyone. In just a moment, I'm going to open up the financial model and share it on my screen so you can follow along a couple of worked examples. Before I do, I just want to introduce the model by saying, so first of all, we have modeled a sort of illustrative medium-sized gold mine in sub-Saharan Africa. So it's not an actual specific mine, but it's very much representative of a mine that you would find in the real world. And we've used a sort of international modeling standard known as the FAST standard, which is fast-standard.org. And that's to make the model as simple and easy to follow as possible, and to make it as transferable as possible. So anybody who is familiar with the FAST standard should be able to pick up the model and use it and adapt it. And then finally, we really want this to be as useful a resource as possible. So we've released it under an open source license, and that means that people are free to download it, to use it, even to adapt it to their own purposes. And all we ask is that if you do so, please email us and let us know so that we can understand how it's being used and how we can improve it going forward. So I'm just going to now open up the model and we'll work through a couple of examples. So when you open up the model, you get this cover sheet, which I won't go through now, but what it does is it sort of explains how the model works. It's got a table of contents for all the different worksheets. It shows you the different entities and financial flows in the model and how calculations and data flow through the model. So if you're a little bit interested in the technical details of the model, that's a really good way of sort of picking it up and trying to understand what's in there. As you can see, there are a lot of different tabs along the bottom here. This set here where all the calculations are done, there's some results here. But what I really want to focus on today is this first tab here called the dashboard. Now, you can pretty much use the model entirely from this one tab, and it's intended to be as user-friendly and as graphic as possible, so that you can really sort of start to investigate and understand the cost of tax incentives and the behavioral responses and what impact they can have. So I'll move over to the dashboard now. And you can see that this screen is in two sections. So on the left-hand side in yellow, you've got the control section. And this is where you can input into the model the different tax incentives that Ali has already outlined and the potential behavioral responses from mining companies. Now, it's fair to say that when we're looking at behavioral responses, we're really making some assumptions about how an investor may respond to a particular tax incentive. It's not necessarily the case that they will do this, but it's intended to give a real indication of risk and orders of magnitude and scale. Now, obviously, in sort of economy-wide estimates of tax policy changes, we have fairly good ideas of how, at a macro level, behavioral responses will impact on revenue yield. When you're looking at an individual investor, it's not quite so accurate. It really is to give an indication of risk and scale. So on this side, in a moment, we'll input some of the tax incentives and behavioral responses. They're grouped by incentive and associated behavioral response. So it's supposed to be as easy as possible to follow along the flow from a tax incentive and how an investor might change their behavior. Now, on the right-hand side in blue, we've got the sort of model outputs, the sort of key results that you're interested in if you're a government or if you're an investor. So this top section here shows government revenues. The chart shows in real terms annual revenues from the project. And you'll see that there are two bars. There are gray bars and there are these blue bars. Now the gray bars are going to show revenues under the benchmark fiscal regime, and the blue bars will show revenues under the incentive fiscal regime. So when I put an incentive into the model, you can watch the blue bars and see how they change relative to the gray bars, and that's going to give you a good visual indication of the impact of the tax incentive. You've also got some tables down here showing total government revenues, both in real terms here and in net present value terms here. So net present value is the discounted cash flows. And then we've got a decomposition of the cost of a tax incentive by the direct cost, which is just the cost of the incentive without assuming any changes to behavior. And then below that, you've got the behavioral cost. So you can see the relative magnitude of the direct cost versus the behavioral response. This side shows the same, but instead of real government revenues, it's the government take. So it's the share of cash flows that go to the government, again, in real and net present value terms. And I'll just scroll down and show you quickly. We also show the project indicators. So from an investor perspective, what is the net present value of the project? What's the internal rate of return? And how are these impacted by tax incentives and behavioral responses? So you can see both on one screen, the relevant information for governments in terms of their revenues, but also for investors in terms of their project returns. So coming back to the chart of annual revenues, what you're seeing here is a fairly typical profile of revenues for a mining project. So in year one, you're picking up some tax revenues from things like import duties on imported machinery and equipment that's used to develop the mine. And then from year two, the mine starts producing. Now, initially, revenues are relatively low. You're collecting royalties, but you're not collecting much corporate income tax because company can carry forward losses made in the development phase, and also the assets that were developed are depreciated. And usually depreciation is accelerated for a mining project. So, you know, over the first 5 or 10 years, quite a lot of the cost recovery is working through before you're collecting much income tax. So you then see it ramping up to here, where by year 13, you're in a sort of steady state and you're collecting the full corporate income taxes on the project. So as I said, that's a fairly typical profile for a mining project's revenues. So let's first of all go back to the control side, and I'll show you how you can input incentives into the model. So each section is a different tax incentive and behavioral response, and you'll see there are two columns for inputs. There's the benchmark column, which is the benchmark or standard fiscal regime, and there's an incentive column, which is where we're going to enter the tax incentives. So the first example we'll do is an income tax holiday. So under the benchmark regime, we've got a 30% rate of income tax. And what I'm going to do is I'm going to, under the incentive regime, input a tax holiday. And to do that, we're going to use this incentive rate here, which is a reduced rate as an incentive, and this incentive period, which is the number of years for which that incentive rate will apply. So if we want to put a tax holiday in, we're going to go across to this column here, the incentive column, and I'm just going to put a 10-year holiday in. As I do this, watch the blue bars to the right and see how they change. So you can see as the tax holiday comes in, we're losing quite a lot of revenue in this period here, which is because we're no longer collecting income tax in the first 10 years. So that's the direct or static cost of a 10-year tax holiday. And you can see down here that we're estimating a total cost of 23 million in real terms. That's on a benchmark total government revenues of 340 million, or in net present value terms, it's about 10 million. So that's the direct cost of a tax holiday. Now we can see what will happen if the investor changes their behavior and if they do the high grading response that Ali described earlier. So for the model, what we're going to do is we're going to increase what's known as the cutoff grade. So that's the grade at which you will consider the ore to be commercially viable and will go into processing and turned into product, versus the ore that is too low grade for processing. And by increasing the cutoff grade, we're going to see two things happen. So what we'll expect to see first is we're going to see production is shifting forwards. And that means we're going to see some increase in revenues in this period here. And that increase is because as more ore is being produced, we're going to see higher royalties in that period. The second effect we're going to see is over this end. And what we'll see here is the life of the mine is going to be shortened, and therefore we're going to lose revenue at the end of the project. So if I now increase the cutoff grade, if you watch in these two areas, we're going to see two things. So we're going to see a small increase at the front end, and then we're going to lose revenues at the back end because the mine is now a shorter life. And if you look back down here, you'll see that the behavioral cost is another 23.5 million. So it's double what we were expecting from the direct costs due to the investors' change in behavior from high grading. And that's because we're losing all of this revenue at the back end because the mine has a shorter life. So that's the first example I wanted to share with you. The second one we'll do is excessive interest deductions in response to an exemption from withholding tax on interest. So in this example, initially we've got a 15% withholding tax on interest. And what I'm going to do is for the incentive regime, I'm going to drop that down to 0. And again, if you watch the blue bars on the right-hand side, you'll see the direct cost of doing that. So it looks relatively modest. You see the blue lines, the blue bars have dropped down a little bit in this initial period. And we're estimating a direct cost of just 6.4 million. So if you don't consider any behavioral response, the cost of an exemption from withholding tax on interest does not look particularly high. However, what we're going to do now is we're going to change the assumptions for borrowing as if the investor were deciding to exploit this incentive by putting more debt into the project and charging a higher interest rate. And now, as Ali explained earlier, that can often be a loan that is coming from a related party in a low or zero tax jurisdiction and can be a way, therefore, to shift profits out of the host government country and into a tax haven. So again, watch these blue bars as I change the borrowing assumptions, and you're going to see these revenues slowly drain away. So the first thing I'm going to do here is I'm going to increase the amount of financing that comes from debt. So we're assuming in the benchmark that it's 60% debt to 40% equity, the same that Ali had in her slides. And now I'm just going to increase that to 80%. And as I do, you're going to start seeing these blue bars drop down a bit. So already we're getting a higher cost just from putting more debt into the project. Then I'm going to change the interest rate. I'm going to double that from 6% to 12%. And again, you see these blue bars drop down. Then I'm going to have a longer grace period before repayment begins. And then finally, I'm going to change the repayment term from 7 to 14 years. And from just those changes to the behavior, you're seeing a much greater cost now over here from the withholding tax on interest exemption. And if you look at the numbers, it's quite staggering. We initially had a 6 million direct cost, but when you factor in the behavioral response, you get an extra 46 million of revenue foregone. So that's a really big impact from an investor changing his behavior in a quite plausible and not particularly controversial way. The one last thing I want to show you on this is, as you can see, we're losing 46 million just from that behavioral response. What we can actually do now is we can put the withholding tax on interest back in at 15% and see how much protection that offers against this kind of excessive interest deduction. So again, watch these blue bars as I put 15% back in here, and you're going to see they shift up quite a bit. And now you're only losing 19 million from the excessive interest deductions. So withholding taxes on interest are a really good protection against this kind of behavior and a really good way to shore up the revenue base. So this has been the IGF tax incentives model. There's a couple of worked examples. Please do go download it, have a play around with the model. There's quite a lot more in here that I haven't been able to tell you because we don't really have much time. And then if you are using it, please do feel free to email us, ask questions. We're more than happy to help, and we're really interested to hear how it's being used. Thank you very much. I'm going to hand back over now to Ali.
Thanks very much, Ian. We're now going to go back to our discussants. So I'd like to invite Mr. Vincent Keddie from the Ministry of Energy and Mineral Development in Uganda to share a few words on Uganda's experience with mining tax incentives. And then after Vincent has concluded, I would like to invite Mr. Ousmane Sese, who's joining us from the Ministry of Mines and Industry in Senegal. Vincent, the floor is yours.
Good evening here in Uganda. I would say good evening to all participants in this webinar. I would like to share Uganda's own experience in regard to tax incentives. Now, in Uganda, tax incentives and exemptions are granted under two categories. First, tax exemptions are provided for under the various tax laws, like, for example, the income tax, the value-added tax law, excise duty, local service tax, and customs external tariff. Now, these tax exemptions in the Income Tax Act are provided under Section 21, and they include, among others, employees earning lower wages being given exemptions, employment income of the police and armed forces being given exemptions, allowances for members of parliament also exempted from income tax, allowances, 10-year tax holiday to interest income of savings and credit cooperative organizations are also given exemptions. Now, the VAT Act provides for exempt supplies, exempt imports, and exempt import of services under sections 19 to 20. Now, the second category of tax incentives and exemptions are granted by the executive arms of government. That means from the president, say, to the Minister of Finance. Now, in the past, the law granted the Minister of Finance considerable discretion to declare any class of income to be exempt from tax. But this was abolished except those under bilateral agreements with foreign countries and accredited international institutions. However, despite the abolition of statutory ministerial discretion in tax matters, we still see some government officials like the Minister of Finance issuing tax waivers in recent years, similar to the abolished ministerial discretion. Now, these exemptions, which are not provided for by statute, primarily take the form of the government paying taxes sometimes on behalf of the taxpayers, or simply the tax being waived off. Now, whereas these tax incentives can be used to attract investment, it can also be repulsive, especially where the provisions are difficult to track, understand, or comply. Particularly discouraging for Uganda are non-transparent incentive regimes, including those subject to frequent change and involving excessive administrative discretion. And sometimes there are no clear guidelines for granting tax incentives to some of the beneficiary companies, and meaning that therefore there is a risk of abuse. And generally speaking, in Uganda, many people feel that the selective award of incentives is also unfair and promotes inequality among sector players in the economy. I would now like to give you some specifically entirely for the whole economy, a certain organization called SEATINI Uganda. SEATINI means the Southern and Eastern Africa Trade Information and Negotiations Institute, carried out a study and established that government in the financial year 2017-2018, the government of Uganda lost almost $400 million in tax incentives alone. In the mining sector, these tax incentives take different forms. Some of them are, of course, income tax holidays, excessive interest rate deductions, VAT exemptions, withholding tax exemptions, sometimes inputs for exploration and mining machinery are zero-rated. There are also royalty waivers for some forms of companies, and there are some who are protected from competition, and the majority of them actually try to rely on provisions in the bilateral investment treaties to try as much as possible to avoid paying tax. Now, in the mining sector, there are some companies that have been given 10-year tax income tax exemptions. But generally speaking, this same study that I'm alluding to has also established that sometimes these companies, after 10 years, they either increase production to make sure that by the end of the tax holiday, by the end of the 10-year tax holiday, either they have nothing to produce, or if there's something to produce, they pretend like they are selling off their interest in the company, and the new company that comes in is also pretending to be new, and also is requesting for the exact tax incentives like the previous one, meaning that essentially they are avoiding to pay any form of tax, implying that the incentives have actually been very harmful rather than useful in terms of enhancing government revenue. Another issue that has been realized in Uganda is that these excessive interest deductions have actually had no impact, very limited impact on economic growth. So essentially, the fiscal regime in Uganda allows foreign companies to expatriate profits. So there has been no, you don't notice any significant economic activity that has been spurred by these incentives. So in my own view, these incentives have to be revisited. And I believe that the work that IGF is doing is really a good way in enabling governments to realize that they have to revisit their incentives regime. That is the experience from Uganda. Thank you very much.
Thank you very much, Vincent, for sharing those comments with us. Usman, can I ask you to take the floor and share with us the experience in Senegal?
Okay, good afternoon, everybody. So then I'm very pleased to join you. I think this project is very useful to our countries. Then to share the experience of Senegal, then we have some issues related to the tax provisions, tax incentives, all this fiscal regime into the mining sector. Based on a study that have been done in 2012, then we come up with an outcome. The Senegalese government, within 5 years project, with the 4 main mining project in the countries. So then the foregone revenue for the government is almost around 400 to 500 million US dollars for the 5 years. At the same time, we collected halfly the 10th of this foregone revenue to the government, almost 40 million US dollars. Then we redesigned the fiscal regime for the general tax provisions, and then later on the mining code. So the problem is here is the stabilization clause, because the mining contract, the duration of the mining contract is the same as the mining license. And the mining license most of the time is taking 15 to 25 years. Then you see that for up to 25 years, the government or the law has frozen the provision into the mining convention, like mostly the fiscal regime. The tax holidays into the mining code, we have minimum 7 years tax holidays up to 15 years. The tax stabilization clause goes along with the mining convention duration. So for the government side, we're looking ways to not to renegotiate, but to distinguish between the feasibility of the project and the economic incentive that may derive for the government. Then into the 2016 mining code, we make some differentiation between the contract itself and the duration of the project and the duration of the license. So the government can grant a long period mining license, let's say for 20 years, but the mining contract has to be lesser than the duration of the mining license, let's say 12 years. Because we consider that if there is any mining project, so from 10 to 15 years, we can come up and renegotiate the terms of the convention while you're having guarantee of the title. So the second issue is related to the stabilization clauses. And Senegal is among of West African Economic Monetary Union. Then they have there is a mining code for the 8 West African economic countries. And this mining code at the regional level has provision on stability clauses. If we have to make changes into the convention or changes into our law, investors most of the time they challenge the government, initiatives based on the regional mining code. So then we have some issues here because the government in 2011 enacted a new law to apply more taxes on production, more taxes to raise the royalties base. But most of the mining companies, since they are in the stabilization clause for almost 15 to 20 years, they don't want the new mining code to be applied. And it's like doing some fiscal shopping into the regional area, like the West African Mining Code, to see ways not to be impacted by the new fiscal regime. There's as well what we call the tax treaties. Just some weeks ago, the government of Senegal, is about to renegotiate the tax treaties between Senegal and Mauritius, because we come up with figures that the two major mining companies here, Mining Gold and the Zircon, most of the parent company are based in Mauritius. So these kind of tax avoidance strategies, and the government is looking way to look at the treaties between Senegal and Mauritius for its own benefits. There's as well the transfer pricing issues. The transfer pricing issues between companies and parent companies and affiliates. So these are as well an issue. Dividend payment for the government. For any mining project in Senegal, into Coma, they say that the government has 10% free carried interest, but at the end of the day, there is no dividend being paid. From my experience into the mining sector, having been here for almost 20 years in the mining sector, then there is only one-time payment by a company. Because if you have to look at the mining convention, there are priorities, reimburse debts, shareholders, and at the third level, then to share profit and then to pay dividend. So the government of Senegal then will be facing this issue. You can have 10% free carried interest into the project, but at the end of the day, because of cost, because of debt, because of various mechanism well used by investors, we never come up with dividend being paid. So those are some issues that we're facing here into the mining sector. And then for the government, there is a risk for revenue calculation. The last one to finish is what we say, the high grading. We're facing currently the same issues. Then I just have a technical paper from one of our technical department, because there is one company, if you have to look at the economic feasibility of the project, what they plan for production, they start producing more. That it seems that they want to, it's like overproduction between the tax holidays phase. Then the government will have his revenue being, not met by the project. So those are the same issues that I would like to share with you. And then I would really appreciate the job you have already done. I appreciate as well the fiscal model that can be useful for practitioners or for government to see, to do some simulation and to appreciate the government cost of the project or government take. Those are the few comments that I would like to do. Thanks.
Thanks very much, Usman. We can see that there are a number of issues both Uganda and Senegal are facing, some of which extend beyond tax incentives and are captured in some of the other work that the IGF is doing together with the OECD on tax treaties, for example, also on stabilization issues and so forth. So it's good to hear that, well, it's good to hear that the issues that we're working on are relevant for you and your countries. Now, we've received your questions via the chat function. Thank you very much for those. I'd like to invite Jacqueline to go ahead in response to the question from Steve Shea regarding the analysis of bilateral investment treaties and their impact on stabilization. After Jacqueline, Ian, I'll respond to a couple of questions, and then Ian, I'll hand to you.
Sure, Ali, thank you. Yeah, the answer is yes, we are. And this is part of our stabilization research work. But it is important to know that most contract arbitrations remain private. So we only have access to investment treaty arbitrations as opposed to contract arbitrations in most cases. What is harder to find is evidence of threats of arbitration to prevent changes in the regime. But we do have some of these examples in Africa under the rubric of resource nationalism. But an empirical study on this time of preemptive use is very difficult. Thanks.
Thanks, Jacqueline. So just to follow up there, as Jacqueline mentioned, the IGF and the OECD are working on a guidance document on the use of fiscal stabilization provisions that we hope to make available later in the year. Turning to the question from Tim on high grading. So we agree with your comment, Tim, that if high grading is possible, then there may already be an economic incentive to do that, irrespective of the tax benefits. So, you know, while high grading with the express purpose of avoiding tax is a possibility, it's also not unusual for a company to want to mine the high value, easy to access ore first to improve cash flow, as you indicate. For example, if there's a gold dome on a copper deposit, the company will mine the gold first. So it's important for us to closely examine the circumstances around high grading. And I've heard Vincent and Senegal, Vincent and Usman in Senegal reference these examples in their own countries. It's important to look at these closely to determine whether in fact this is a response to the tax regime or if it's simply a mechanism to improve the profitability of the mine. Ian is going to respond to your point around how this is represented in our model, but just before I conclude, again, the comment that you made around transfer pricing regulations relating to excessive interest deductions. So normally we would expect to see most countries having transfer pricing rules that would allow them to attack the interest rate or the volume of debt if it is considered not arm's length, as in not the amount of debt or the rate that you would expect to see between independent parties. So if there are transfer pricing rules, then the government should be able to address it that way. But the point of the presentation here today is to highlight this as a risk to revenue and a risk that can potentially be avoided or mitigated to some degree by not necessarily offering incentives relating to withholding tax, particularly on interest expense, given that mining is very capital intensive and often requires a lot of debt early on. So I hope that responds to your question. Ian, can I invite you to deal with a couple of questions relating to the model?
Yeah, thanks, Ali, and thanks everyone for your questions. So I'll just pick up on the question from Tim on high grading. I'm just going to share my screen and the model again. And you should now be able to see the model, and you can see I've put back in the specific tax incentive, the income tax holiday, and the high grading response. Now, in the model, the way we can see that this is a risk is that we can look at the project's net present value at a range of different cutoff grades for the two fiscal regimes. So I'll show you what that looks like now. So again, we're using this gray line is the benchmark fiscal regime, and the blue line is the incentive regime. So that's the regime that includes a tax holiday. And you can see that the NPV optimizing cutoff grade for the benchmark fiscal regime is here, 0.7, but under the incentive regime with a tax holiday, it's 0.8. So in the model, you can see that there would be a financial incentive to increase the cutoff grade to maximize your returns in net present value. So that was a question from Tim. Steve Shea, you had a question about whether the analysis considers the increased returns to the government through dividends as a shareholder. So the model includes a whole host of different fiscal instruments and is dynamic. So if you change one tax instrument, it's going to feed through the model to all the different tax instruments. Now, we haven't specifically included a government share in the project as a shareholder, but we do have withholding tax on dividends. So if the government were to take a sort of free interest in the project, you could model that, say if they had a 10% free interest, you could model it as a 10% withholding tax on dividends. You could actually quite easily build in an equity share for the government into the model with, fairly straightforward additional calculations, but out of the box, it doesn't yet do that. And then Daniel Dumas, you had a question. You said you were surprised how little the government take figures change in the model. I think one reason for that is we're only actually looking here at a single tax incentive. And what you tend to find is governments, as we saw from Jacqueline's work earlier, they don't just give away one tax incentive, they give away 8 or 9 on average. And once you get the compounding effect of those, you begin to see really big changes in the government take figures. So that's the share of the revenues that go to government versus the company. The other thing is, if you were looking at the net present value government take, so the discounted terms, and you were looking specifically at the behavioral response to the income tax holiday, you're going to see a very small change there because, of course, all the revenue losses happen right at the end of the project when discounting is at its highest. So in net present value terms, that behavioral response doesn't look particularly big. So I think that was it for me, Ali. I'll hand back over to you for some more questions.
Thanks very much, Ian. And just to let everyone know, Alison Christians is posing as Stephen Shea on our webinar. Thanks, Alison, for your questions that we've responded to. We have one final question from Burkina Faso. So that's come through in French. So we're just having a quick look at that. Apologies, we are unable to speak French. However, I understand we've just received a translation that says, I'd like to have a clarification on a situation in Burkina Faso in relation to our fiscal stability clause. In our country, some mining companies obtained their license and mining convention before 2010, during which period the corporate tax rate was 30%. The mining sector benefit on the basis of the mining code of 2003 from a reduced rate of 10 points, so a rate of corporate income tax of 20%. From 2010, there was a decrease in the standard tax rate to 27.5%. So we can see that there's been a number of changes to the law. And so we've got subsequent generations of law in Burkina Faso, and in each instance, the rate of tax that's applicable has changed. I think we can provide a further response, a more detailed response to this offline. Sorry, because it's difficult for us to read and understand this straight away. However, I think what you will see from our tax incentives data set, database that we've just shared with you today, and when you get access to it yourselves, you'll see that we've used the primary law that's currently in force. So the general tax code and the mining law that is currently in force in the countries that we've included in the database. So this might mean that if you've got a contract that was signed 10 or 15 years ago, that the benchmark fiscal regime may have been different at the time when it was signed. So we are looking at those contracts based on the law that is currently in force and determining whether or not the terms in those contracts are considered an incentive relative to the current fiscal regime. So that's the first thing to note in our database. However, this highlights a broader issue for countries such as Burkina Faso, where you have contracts that are much older, that predate the current law, that have been stabilized. And as such, the rate of tax is much lower than the current rate in force. Here, obviously, there may be some limitations with respect to how the stabilization provision is drafted and whether there is an opportunity to revisit the rate and indeed other fiscal terms included in the contract. And that's something that we will include in our guidance document on fiscal stabilization later in the year. What are the opportunities with respect to revisiting stabilization provisions, and as a result, the terms included in the contracts, and looking forward to how, if countries are to use stabilization provisions going forward, how they can be drafted in a way that is provides predictability for investors, but also some opportunity for government to revisit the terms from time to time, subject to discussion with the investor. So that doesn't answer precisely the question raised by Burkina Faso, but hopefully provides some insight on the issues around that particular question. We've just received one last question before we close. So where there's a decision by a country to offer a certain incentive, are there any specific policy measures that IGF might recommend countries consider to combat the behavioural responses that have been highlighted? Thank you for that question. Indeed, if you look in our practice note with the OECD on tax incentives in the mining sector, you'll see that on page 16 of the guidance note, it includes a number of suggestions or questions to ask oneself when considering the design and use of incentives. So, for example, does the tax incentive create parallel fiscal regimes side by side? So incentives that apply to one segment of the value chain, for example, the processing facility, and exclude others might create opportunities for transfer pricing. Does the incentive create cliff edges? So, for example, if you're going to give a tax holiday, is the tax holiday limited in terms of fixed number of years, in which case creating an incentive to shift profits earlier to avoid paying taxes when the incentive ends? So I think there's a number of issues that we highlight in the practice note or recommendations as to how to design and use incentives in a way that will limit the risk of the behavioural responses that we've discussed here today. And of course, at the start of any process, it's important to model these incentives to see firstly whether they're actually necessary to attract investment. So that's the fundamental question that needs to be answered before considering the type of incentives and how to design them in a way to minimise the risks to revenue. So thank you very much for your participation today. We're really pleased that so many of you could join us. We hope that it's been interesting and useful for you. I'd like to extend our thanks to Vincent and Usman for joining us from Uganda and Senegal. We really appreciate your contributions and look forward to continuing to work with you both. You will receive a follow-up email from the IGF after this webinar, which will include the slides that we've presented here today, as well as the practice note, the database, and of course the financial model. And we invite you to visit the IGF website for more information on the IGF and OECD program to address base erosion and profit shifting in the mining sector. Thank you very much and have a good afternoon or a good